We are live. Everybody cool? You guys should be able to hear me no problem now. Alright. So the topic for today, and like I said, this isn't something that you will see. There's one that you will never see. So we're going to talk about two different but similar spreads. One you'll never see come out of either of our rooms. One you may very, very, very rarely see come out of Scott's room. So this is about what are called ratio and back spreads. Similar, but not the same. Okay, so anybody want to throw out something that is liquid and has options on it and everything? You guys, it doesn't really matter. It's just theoretical. Okay, Bowen. Mickey was first. Sorry, Avi was first. Boeing. Okay. So, what a ratio spread is, and it's just like it's called, it's a ratio of two different strikes. This is all going to be done typically in the same month expiration, weekly or monthly, it doesn't matter. And what it is putting together, so let's look at Boeing here. Boeing is trading about $161.50. And let's just go out to regular August, since that's going to be a little bit more robust. Okay, so first we'll talk about what a ratio spread is. A ratio spread is buying one lower struck call, and we'll stick to the call side. You can do a put ratio and a put back spread as well, but we'll just for ease, we'll talk about this on the call side. So let's look at the 170, 175 ratio spread. So 170 is one of our strikes. 175 is our other strike. We're going to buy one of these, and typically it's done at a 1/2 ratio. Buy one, sell two. This is the one that you'll never see. This is the one that you will never see come out of our room. Either room. Why is that? Anybody have a guess why you'll never see one of these come out of our room? Exactly. You guys got it. Because what this is actually, this is the 170, 175 call spread, 1-to-1, and then we just tack on an extra sale of another 175 call. Right? We net these together. No problem. 1 by 1 by 1, or if you put these together, 1 by short 2. Now there's not more money requirement. We're actually getting a credit to do this. We're actually getting money to do this. So, if Boeing were to go to 0, yes, you will have margin on this because you're naked short, and that's why I'm saying that you'll never see one of these come out. Let's just make this a nice 245 just to be nice and round numbers here. We're getting $2.45 to put this on, which is great. Right? I'm going to put this back to 1/2, but I just want to let you guys know what this is. Okay, so anywhere from 170 on below, we're going to take in our whole our $2.45. Where's the best place for this to go? Best price at expiration. Exactly, Pamela. With any sort of call spread, ratio spread, not a back spread necessarily. Not a back spread. But if we go to 175, what happens here? Well, essentially we're along the 170, 175 call spread once, That's going to be worth $5, and we got an extra short call that's worthless. So not only do we collect $2.45 to put this on, but we get another $5. That's fantastic, right? But, like we said, this isn't without risk. What happens if we start going up? If we go up to 180? If we go up to 180, then we have a $10 call spread that's in the money. We have two. The 70-75 is $5 in the money. Or excuse me. Well, we can look at it one of two ways. The 170 calls that were long are $10 in the money. The 175 calls that were short are $5 in the money, but we have two of them. So now, we're still making money here. Still making money because, remember, we took in $2.45 to put this on. But if we eat into that, 182.45, well now, I have a 170 call that's $12.45 in the money, and I have a $7.45 call that's in the money that I'm short twice, so $14.90. So now I lose $2.45 on my spread. Don't worry, I took in $2.45 to put on the trade. No blood, no foul. Okay, what happens if we go up to 200? Oh boy. Look out. Because now we have a 170 call that's $30 in the money. We have a 175 call that's $25 in the money, but we're short two of them. So net, we lose $20. We still get to keep our $2.45, but we lose, for each one lot of these, 1 by 2 that we do, we're going to lose $1,755. So it's great if you have a grind up. If, let's just say, hey, you know what, Warren Buffett came in and said that, you know what, I'm just going to buy Boeing. I own enough of this thing. I'm just going to buy the whole darn thing, and I'm going to pay $250 because I know that this thing's going back to $400 at some point. Well, now you're in big trouble. You have unlimited potential risk to the upside. Okay? Well, Mickey, that's the first thing I said. Is long 175 or lower. 175 is the best place to go. 170 or lower, you take in the $2.45. At 175, you maximize the things that you're long. Excuse me, put that in the wrong cell. And you have no ill effects from the thing that you're short. But like I said, if you guys tried to put this, most of you, I would say 90% if not more of you, if you tried to put this order in, it would immediately get kicked out. Because why? Because you don't have just the same way that you can't just go out and sell straddles or sell a call that you don't have the underlying, or sell a put where you don't have the cash secured to do a cash secured put. Well, Mickey, yeah, I mean, if you can guarantee that it's not going to explode on you, they're great. Just like everything, there's no free lunch. And usually when you get these moves that hurt you, they tend to be binary, or when the market's not even open. What are you going to do then? You can start trading stock against this thing? I'm not saying that you can't do it. I'm saying that there are inherent risks, and you need to at the very least, know what those risks are. 5,000? You probably, I don't even know what the margin would be on something like this. I would imagine it would be a lot. They're probably going to be looking at this, 2 or 3 sigmas out to, I don't know what their exact calculation is on these short 175s. But essentially go, see what the margin is on selling, 175 call, naked. It'll be offset a little bit by your call spread that you're long, but you're not going to, I'm thinking that you're not going to have permissions to do that, Antoine. It works like it works on any stock, any ETF, any future, anything. But the thing is that you'll never be able to put these on without a ton of money in your account. Well, yeah, but it moves slowly. But does it move enough? I mean, that's always going to be the case. What? Okay, and like I said, you can put these on the put side too. It's the exact same thing except to the downside. Let me see if I can get you a risk graph so we can look at it at least. And let me pull up my friend here. We are in Boeing options, regular August, 70-75 call spread. I'm long one of these. I'm short two of these. What does that look like? Let's go out to August 21st, which is expiration. Get rid of all these guys. Okay, and then let's look at this 50% out. So you can see that we make a little bit of money here. In between 70 and 75, we make a little bit more money because we're long that call spread. But then, once we start moving up, we have potentially unlimited upside loss. Yeah, if you can guarantee me something that doesn't move, there you go. I don't know of those guarantees. Well, if you close it, they're not limited risk. They're unlimited risk. I don't care when you close it. If AT&T, with 3 weeks to go, or let's just use Boeing. Here, Boeing is trading 161 half-ish. If Boeing opens up at $200 because there was some buyout or they made a huge breakthrough in the 737 and, we're going online next week, whatever the story is. You've seen enough stories come out lately that really nothing should surprise you. There is not limited risk. There is unlimited risk. That's what I'm trying to bang into your heads here. Now you can say, well, it's probably not going to move that far. And you're right, it probably is not. The fact is, though, that when it does, it's going to blow you out. Okay? That's the ratio spread. You'll hear them called 1x2s. You'll hear them that too. But it doesn't have to be 1x2. It can be 1x1.5. It can be 1x3. It can be whatever it is. A 2x3. The thing is that you have some sort of ratio. If you do it on the put side, isn't that like Scotch wish list? It could be. That's if you are assigned. What if it goes to 0? And they don't. You're just long from the strike, less the credit that you receive. You can't get out. All you can do is buy your short put back. Your extra dangling put. It's a lot like it's like that. But like with the wish list, that's saying, hey, you're gonna get short. You're gonna get short this thing. Q, is it better to sell it sooner than later if it doesn't? Option is in the money as it devalues or decays towards. I don't really understand. It depends where the underlying is. Is it better, is it better to close it or not? I mean, of course, taking off risk is going to take off risk. That's a pretty easy one. But to say, that's like saying, is it better to sell something a day later or 2 weeks later? Well, tell me where the underlying is. Tell me where the options are. Where did I get in? What was my risk? Where was my stop price? There's a lot of things that go into that. I wish that, trading could be, do A, then do B, then do C. In every case, you go from A to C. Your journey from A to C can change wildly, right? We could put the underlying, let's just talk about stock. Let's say we buy a stock for $100. 3 months later, at expiration, or, when we just, 3 months later, it's trading $100. Nothing happened. But it could have gone from 100 to 50 to 150 to 10 to 200 and then ended up at $100. And at the end, you're like, wow, nothing happened. Well, yeah, a lot happened in between now and then. Or then and now. Okay, let's look at a back spread. Somebody throw out an underline. Whoever's first wins. Back spread, back spread, back spread. Walmart. Antoine's first. Let's get Walmart up on the board here. All right, Walmart is trading, where's what? 20 half, 120 half. Let's clear this data out here. It's not letting me use the macros. Okay, we're going to do this from the call side again, just because it's no different, but I think when you're first learning something, it tends to make more sense from the call side than the put side. That's learning what a call and a put is, call spread, put spread. It's just the way that, our minds are hardwired. Okay, we're going to do this from the call side again. So, a back spread is the exact same thing as a ratio spread, except you're on the other side of it. Okay, so let's look at the 170, oh wait, hang on, that's still, and let me get rid of this so we don't start doing trades that we don't want to do. Okay, again, going out to regular August, this works for weeklies, this works if you go out 4 days, 4 weeks, 4 months, it's the same thing, it doesn't matter, just a matter of how long you have the option on. Okay, so here let's look at something like we're trading just shy of 130. Let's look at a 133, 135 back spread. 133, 135 back spread. Now in the case of a ratio, we buy one, sell two. In this case, we sell one, buy two. And let's pull this up. We got Walmart. And what I say, a 33.35 for regular August. So 33, we're going to sell one of these, and the 35s, we're going to buy two of these. This market here, we're going to have to pay 80 cents for this thing. Thereabouts, somewhere between 75 and 80. Let's be nice to ourselves and say that we can get in for a debit of 75 cents. So now why? And notice that in the trading tool, I have a negative number here because that's money that is out of our account. So it's negative. Right there. Pamela, I'm arbitrary. Just out of the money. I didn't pick my strikes based on anything. You would look at normally you would look at what the implied vol is and where a normal move tends to be or whatever. But here, so what do we have here? Oops. Got to get back on the pointer. So now what we have, now we are short the 33.35 call spread, but we have a 135 call in our back pocket. We're long that call. Where's the best place for this to go? Okay? At 132, what happens? At 133, what happens? Let's do 133, 122. Anything. Here, let's look at 133. Okay? Remember, so I'm short a call spread here. I'm short the 33.35 call spread. I'm long the 35 calls. All at expiration are worthless. I like Robert's answer. Remember, we had to pay money to get into this. So anywhere below 133, we lose all of our money. We just paid to watch this movie and we didn't get even to see much of the movie. Okay, well, what about if we go to 135? That's the worst place we can go. Because now we have a call that we're short. That's $2 in the money, and we have 2 worthless 135 calls. So we lose $2, and we paid for the right to lose $2. That's not good. We lose $2.75 on that. That's the worst place we can go. At expiration, where's our break even? We're short a call spread. And we're long a call. So we know that we need to be north of 135 for sure. Well, what happens at 135.75? Well, at 135.75, I'm short a call spread that's $2 in the money, and I'm long a 75-cent call, or 75 in the money call at expiration. So net, I still lose $1.25, and I had to pay for that, and I lose $2. Okay, your break even, and you can look at it this way. We're short a call spread, right? 33.35 call spread is going to be $2 against us. So we have to make up that $2, and we have to make up whatever debit that we get into it for. So $2.75 above the 135 strike is where our break even is going to be. Because then we have a $2 wide call spread that's against us, 475 minus 275. We have a 135 kicker in there for us. That's $2.75 in the money. So we lose $2, we lose $2.75, or we make, $2.75, but we had to pay 75 cents to get in. That's your break even. So what you need, now what you need is a blowout move. Let's go to 140. Well, we have that same $2 call spread that is against us. We paid 75 cents to get in it. So we have $2.75 of premium to make up. Well, we got a $5 in the money call. This 135 call is now $5 in the money. So we have a $3 call, or a $3 spread that we have on that's in our favor. No matter what, we have to pay this 75 cents. We make $2.25. So you can see how you need a move that is very, very out of the ordinary. So putting on a back spread can be difficult. Things that do work, and you'll see Scott do this. I haven't seen him recently that I remember, but VIX is something that can move like that. Look, on a nothing day like today, VIX is down 0.5%. It was up actually in the beginning of the day, which I thought was interesting. But we've continued to move up. But we've seen the VIX. VIX could go from 25 to 40 in a day pretty easily. 25 to 35, no problem. Those are the type of things that you're going to have those binary moves. Of course, they're going to be kind of expensive because anybody who trades VIX professionally knows, that a lot of times, if nothing's happening, the VIX just bleeds off. That's, hey, nothing's happening, sell some VIX. Get some premium. Oh my God, Mitch McConnell just resigned. What the hell is that going to do to the market? Does it go up? Does it go down? Who knows? It's not saying here, though. Well, there you go, David. And that's where you get, when you get a percent move, if you put on a back ratio. It's up 200% today. You can get those moves. So these are trades that you will see. Not that often because, you can be right. Let's just say that we're trading 130. Let's, for round numbers, we're trading 130 in Walmart. Well, this is a bullish spread, right? Let's clear our sims here, and we're going to do the August 21st. I don't want VIX, I'm sorry. We're still on Walmart here. I want the August 21st 33.35 call spread, and that's what we have. Short 1, long 2, we're long the backs. This is what our risk chart looks like. Let's go to expiration. Let's get rid of these expiries. So we can see, this is just the same thing as a ratio spread, except it is mirrored over the x-axis. Same thing. We lose money if we stay here or go down. We lose a little bit more money as we go towards our long strikes, the 135s. But then, if we blast through 135, potentially, if we go to 500, well, I'm long these 135 calls, basically, for $2.75. Well, they're $365 in the money. No, Tim. I was just saying what happens. What would be something that would shake the market like that? So for each one lot of these that you did, now of course Walmart has to go from 130 to 500, but you would make $36,225 per one lot. Well, if Mitch McConnell had resigned, I wouldn't be doing this video right now. We would be trading, or at least trying to. Okay, any questions on ratio spreads or back spreads? And like I said, this is something that doesn't come up often, but at the very least, it helps you learn how to think about this stuff. What is it that we're putting on? Just like, broken wing butterfly. All that is two vertical spreads put together. One's wider than the other one. Yeah, it sounds complicated. When you put it up on a risk chart, it looks complicated. It's a call spread versus a call spread. What's a back spread? Back spread is selling a call spread, buying an extra call. What's a ratio spread? Buying a call spread and selling an extra call. If you do it 1 by 2. How are they used? I just showed you how they're used, Tom. If you don't think that, if you think you're going to the short strike and not much more, then buy a ratio spread. If you think this thing's going to blast through your higher strike, buy a back spread. Like I said, you need, to get hurt, you need a move that is not expected. To make money, you need a move that's not expected. So by definition, unless you know something that the whole world doesn't, it's a bit of a crap shot. I'm not sure what that means, Tim. 234 Gina. I don't know what that is. Okay. Any questions on that? Tried to keep this relatively short. It's a little bit less than a half an hour. And this is, like I said, more informational, but it gets you thinking about what you're putting on. This stuff is complicated enough without making it more complicated for ourselves. All right, there you go, David. Okay. If there are no other questions, I'm going to render this video. I will get it out in the room. I'll put it up on the blog. Danny will probably have it out on social media before I'm even done with it somehow. All right? It's a good question. Like I said, all it can do is get us thinking and understanding options better, even if we don't use it. You think about it. It's important. All right. I appreciate it. Anybody that wants to throw other topics out, we're sitting here at 145. Hopefully we get a little bit of trade. Looks like we're just grinding up here, which is not fantastic for trade. We might be looking at some ledges, some profit taking. Okay, the Excel spread, I've posted it a couple times. Is it a hard G, Gian, or is it Gian? I don't want to, is it like G on? Or like ghee on, like clarified butter. Gayon. Okay, thank you. Not even one of the two I threw out there. I obviously don't mean anything personal by it. I don't want to call you by something that's not your name. Okay, let me get this out to you. I appreciate the input and everything. Scott will be back with us for some last minute stuff. I would imagine I will talk to him ASAP, but let me get this going here. All right, thanks a lot, guys.